Ever wonder how businesses manage loans? It all starts with a debt schedule. A debt schedule is a detailed table that outlines a company's debt obligations. It's essentially a roadmap for how and when debt will be repaid. It also shows the company's ability to service its debt. The core financial components of a debt schedule include drawdown, repayment, interest expense, and debt service. Drawdown is the amount of debt that has been withdrawn or utilized from a loan facility in a bank. It represents the actual borrowing from a credit line, and not just the approved amount. Repayment is the scheduled return of principal to the lender over time. Interest expense is the cost incurred for borrowing funds. It is calculated by multiplying the outstanding loan balance and interest rate. As you can see here, interest expense changes with the change in the interest rate and loan balance. And debt service refers to the total amount of cash required to meet debt obligations in a given period. It is composed of the annual interest expense and principal repayments. To assess a company's ability to pay its current obligations with operating income, debt service coverage ratio is measured. It is calculated by dividing unlevered free cash flows in debt service, with the minimum amount of 1.5 times considered as generally acceptable. It ensures the company generates enough cash to safely cover debt payments. As you can see here, this ratio is automatically calculated along with 3 other bank ratios, and any changes in the input assumptions will also affect the corresponding ratios. Debt/EBITDA ratio measures how many years it would take a company to pay back its debt using EBITDA. It is calculated by dividing total debt to EBITDA with a maximum of 3.0 times considered as generally acceptable. Higher ratios signal higher debt burden and greater default risk. Next, loan-to-value ratio. It answers the question how much of a project's value is financed by debt. This is especially important for infrastructure projects such as solar or wind parks. It is calculated by dividing debt to its gross fixed assets, with 65% to 80% as the benchmark percentage. Interest coverage ratio measures how easily a company can pay interest on outstanding debt from its operating income. It is calculated by dividing EBIT to interest expense. The minimum thresholds vary, but 2.0 times is generally considered acceptable. To provide a quick overview, here are the benchmark or generally acceptable amounts for the following bank ratios. While these ratios affect loan terms and costs, it is also important to note that it still depends on how you negotiate with the bank, as some might consider going below or above these amounts. While these ratios offer great insights, each has its benefits and limitations. Let's break them down simply. DSCR provides a comprehensive debt coverage, showing a holistic view of a company's repayment capacity. It is lender-focused and focuses on the unlevered free cash flow. However, its limitations include, it doesn't typically account for other fixed operating expenses that are not debt-related, such as rent expenses, as well as one-time events, so extraordinary income or expenses can skew the ratio, and it is only based on past financial performance. For debt to EBITDA ratio, it provides a quick snapshot of a company's overall financial leverage. It is widely used by credit rating agencies, and it shows if a company is relying heavily on debt versus equity to finance operations. However, its limitations is that it doesn't account for capex, it excludes interest and taxes from the computation, and when comparing with other companies, it needs to be industry specific. For loan-to-value ratio, it is one of the primary tools for lenders to assess the risk of a loan. It impacts the loan terms and costs for borrowers, and it helps plan for the additional equity needed. Its limitations include, dependent on asset value used in the calculation, it doesn't reflect the full financial health and it ignores other liabilities. Lastly, for interest coverage ratio, it measures a company's immediate solvency. It shows early warning signs of financial distress, and it focuses on the company's operating income. Its limitation is that it ignores principal repayments. It has highly volatile earnings, and comparisons between companies must be within the same sector. Well, that's all for now. I hope this video helped you understand the functions of a debt schedule and how it impacts bank ratios. If you're also looking to map out your debt schedule, we have our easy-to-use 3-statement model, free to download on our website. Don't forget to like and subscribe. Thanks for watching.